Hello, Baker Investment students. We are in week 5. We are quickly approaching the end of the course, so just keep plugging along. This week you're going to read chapters 9 and 10. You have your quiz for chapters 5 through 8. Continue with your forum discussion and the homework. And we do get a bit of a break this next week, so do continue to work on your final 2 projects, your papers. Again, you have the choice of this to select who you want as the investment guru, if you will, and the crisis that impacted the financial markets. It could be subprime, it could be COVID. It's your choice. It could even be the war in Ukraine right now. So if you have any questions on that, do email me. But to give you some quick insights for this week, with Chapter 9, if you've had finance, you probably have seen the topic before about a first market hypothesis. Eugene Fama, which I put a video out there, was the one that came up with the concept and won a Nobel Peace Prize for it in economics. But what Eugene was trying to explain is that within markets, that it's very difficult to outpredict the market or know exactly when to buy or sell, because there's so much information out there about the stocks and everybody's competing for that same information. The theory says that that price should be accurate at that time given the available information. It'll be hard to profit from that. There's various degrees from, he goes from weak to semi-strong to strong. Weak form basically says that you can't use things such as past prices and historicals to try to predict the future. Now, what is interesting, what you're going to read about in this chapter 2 is technical analysis, which a lot of fundamental financial people would say it's all baloney. You can't use charts and looks at different things. You should be looking at the management and the fundamental and the cash flows and the ratios. That's what I prefer to stick with, but there's enough people that pay attention to the technical markets that we have to recognize it. The medium form says that, if something comes out about, it's Walmart and their quarterly earnings and how well they're doing, that stock price should adjust almost immediately. And the strong form says that even executives, they have to report through the SEC when they're buying or selling, so they can't do better than everyone else. So I like to use the analogy of a grocery store and trying to check out the checkout line. Everybody's competing for the same information about how long it's going to take you into that line, because everybody's competing, and sure enough, what happens, you get a line, and it seems like the other line is moving faster than the other one. Well, because so many people are competing, it's hard to outperform the S&P 500 or the market. That's the basic premise of the first market hypothesis. In fact, they did a thing called the dirt versus the pros years ago in the Wall Street Journal. I think when they originally did it, they had monkeys throwing at a dartboard with all the Wall Street Journals, all the stocks listed in the Wall Street Journal, and they asked professionals which stocks they would pick, and they found out the monkeys did just as well as the professionals. So it was kind of trying to prove their point that the markets tend to be very efficient, and that's why I've always told my students that don't over sweat it too much. If you just pick an S&P 500 fund to invest for your retirement, a lot of professional money managers have a hard time beating that S&P 500, which has averaged about 10% historically over many, many years. So, but you're going to read a little bit more about that. I kind of like to call it like the truth in finding value. So, all right, chapter 10, you're going to look into bonds. You're going to look at all the various types of bonds, understand, again, how they're priced at market. Obviously, with interest rates rising so quickly, it's happened to me, even, some of the bond portfolios that I own through Fidelity, they have just got hammered the past 3 years. And the reason is bonds, it's an inverse relationship. They're price mark to market. So as interest rates go up, the present value of that bond is going to drop. And that's exactly what happened. And as we kind of watched last week with the Fed taking the pause, we have historical short-term rates about 5.25%. You can find CD rates about that rate too. For about 9 months to a year, but it sounds like they're not done yet. So the bonds are still probably, until those interest rates reverse, you're going to see those bond prices really getting beat up. And if bonds do pay back the face value, it's just kind of as if right now if you were to sell them, and that's why they've really been struggling the past 3 to 4 years. So, but Obviously, bonds can sell at a discount below the price, which they are now. They can sell at a premium. So when the interest rates start to reverse, and they will eventually, those bonds at higher rate will go for a premium. You're going to learn all kinds about different types of bonds, where bonds can be converted into shares of stocks, government bonds, municipal bonds. Municipal bonds often have tax advantages to them, even though they pay a different yield. They may be exempt from federal and state income tax. And you're going to learn about bond ratings too. So, well, I'm looking forward to your phone post later in the week. I really have enjoyed reading them. Continue. Good luck in the stock market this week. We'll see what happens. But if you do have any questions, do reach out to me. Able to keep it brief this week on the video lecture. But do enjoy your time off next week. But do take a little bit of time. Try to get some of that stuff done so there's less stress in the class to get those 2 projects done. So take care and have a great week.